Okay, hello and welcome everybody to today's webinar. Today we're going to be talking about gold trading strategies. This webinar is brought to you by OctaFX, the award-winning Forex broker offering some of the lowest spreads in the industry. So without further ado, let's jump right into it. First of all, a quick bit of housekeeping. A risk disclaimer: trading on margin carries a high level of risk and may not be suitable for all investors. You shouldn't invest money that you cannot afford to lose. Secondly, a hypothetical trading disclaimer: the information in this webinar is provided as general market commentary and doesn't constitute a specific investment advice. So we're going to be talking about some specific strategies, and it's more presented as educational material rather than specific trade recommendations. Let's take a look at what we're going to cover today. We're going to look at gold's history as a currency. We're going to get a bit of background on gold and its history, how it's been used throughout the ages, why it's so valuable. We're going to look at some of the key drivers of the price of gold. One of the major ones is gold's relationship with interest rates. We're going to look at the famous US dollar gold correlation and see how that really holds up, the negative correlation between the US dollar and gold. We're going to discuss gold as a safe haven appeal. And finally, we're going to look at some technical strategies for trading gold. So first of all, let's look at gold in history and the origins of the use of gold. Gold played an important role in ancient Egypt 5,000 years ago, so 3000 BC. You see it a lot in ancient Egyptian mythology. It's used as an indestructible and heavenly metal. It was used in their religious rites where the kings were buried. The tips of the pyramids were capped with gold. But actually, in ancient Egypt, gold wasn't used as a currency. They had instead they had a very complex barter system where they'd use agricultural commodities such as barley as means of exchange. So the first civilization to actually use gold as a currency was the Kingdom of Lydia. You may not have even heard of that, in Asia Minor, which is now Western Turkey, and this is all the way back in the 8th century BC. They had coins known as electrum, which were crudely crude lumps of a mixture of gold and silver, 63% gold and 27% silver, but they were pioneers in using gold as a form of currency. So as a result of having this form of currency, the kingdom became wealthy, amassed a huge hoard of gold. A bit closer, in about 500 BC, was the time of the king Croesus, the last king of Lydia, and this is where we get the expression "rich as Croesus" from the wealthy kingdom of Lydia in ancient times. So after that, the Mycenaean civilization also used gold, as did the Greeks and the Romans, although more commonly they used silver. Let's zoom forward to modern times and look at gold in a more contemporary period. From the Great Depression in the 30s until President Nixon took the United States off the gold standard in 1971, the price of gold was fixed at a set price of $35 an ounce. Following the removal of the gold standard in the early 70s, the price of gold skyrocketed 2,200% in dollar terms to reach above $800 an ounce in 1980. So that's from $35 to $800 an ounce in 1980. Pretty dramatic move over those years. And then gold entered a long bear market where there was strong economic growth and strong stock markets. Gold stayed in a pretty tight range for 20 years. Between 1982, gold stayed in a range between $300 and $500 an ounce. Then we saw a massive rally in gold. gold soared with the onset of the financial crisis in 2008, reaching record highs above $1,900 in 2011. So since then, gold has retraced a little bit, but we saw record highs above $1,900 with amid the financial crisis. So moving on, let's take a look at why gold is so valuable. Warren Buffett, the famous value investor, is famously critical of gold, pointing to its lack of utility. Gold does have some utility in industry, but very little compared with other metals like copper, for example. So why is it that gold is so valuable? A single ounce of gold, which is roughly the size of a sugar cube, sells for $1,200. So why is gold so valuable? First of all, due to its chemical properties, it doesn't rust or tarnish. So it has some unique chemical properties. Secondly, it's easily malleable and ductile. It's easy to make stuff out of gold due to its malleable characteristics. It's extremely rare. All the gold ever found would only fill 2 Olympic-sized swimming pools. So there's not a lot of it out there. It has a timeless aesthetic appeal and attractiveness to the human eye. From the time of the ancient Egyptians until now, people still want to use it as wedding rings and jewelry and so forth. It's highly liquid, which means it's easy to buy and sell. It's easy to take your gold and exchange it for cash. It's portable, at least to some extent. You could carry, $100,000 worth of gold in your pockets. That's relative, I suppose, compared with Bitcoin. It's not as portable, but it's divisible. So compared with a commodity like diamonds, diamonds will lose their value when they're broken into smaller diamonds, but gold will keep its value when it's divided. It's impossible to counterfeit. So unlike cash, which has been counterfeited, gold is impossible to counterfeit. And finally, and perhaps most importantly, it can't be inflated artificially. So this is referring to what's going on with the fiat currencies right now, the currencies that are not backed by anything. What we've seen is that the value of currencies such as the US dollar and the euro have been diluted by the activity of the central banks, specifically the programs of quantitative easing, where the banks have been lowering interest rates and printing money out of thin air. So while central banks can print fiat currencies out of thin air, gold can't be reproduced out of thin air. So it can't be inflated artificially. There's a limited amount of it out there, and so it's less vulnerable to inflation and having its value diluted in that way. It's also the appeal of Bitcoin. You may have seen Bitcoin reaching $10,000 and rallying in a parabolic move recently. So those are some of the reasons why gold is so valuable and has kept its value from ancient times until today, trading above $1,200 an ounce. Okay, now let's get into things that are going to be useful in terms of trading gold and gold trading strategies, which was the subject of the presentation. So let's talk about gold and US interest rates. It's one of the major drivers of the price of gold. The level of real interest rates, which is the interest rate less inflation, or the interest rate minus inflation, is among the major long-term factors that influence the price of gold. So this is something you're going to want to be aware of, particularly if you're holding gold over a long period. Not so much if you're a short-term trader of gold, but it is good to be aware of it. So the logic behind this is that when real interest rates are low, or interest rates adjusted for inflation, that is, cash and bonds provide a low return. So investors look to gold as an alternative investment. So again, cash and bonds become less appealing when interest rates are low. For obvious reasons, they yield less. Investors look to alternative stores of value, such as gold. Conversely, when interest rates move higher and other assets like bonds, cash, and stocks increase in value, gold loses its appeal versus these investments, because gold doesn't yield interest and it doesn't yield dividends like some stocks do. So how do we keep track of this? One easy way to see a proxy for real interest rates in the United States is to look at the yield on the Treasury inflation protected securities, otherwise known as TIPS. So historically, if we look at this, real yields below 1% have been supportive of gold prices. So when real yields are below 1%, we see more strength in gold prices. And real yields are currently below 1%, so we can see this is something that's supporting the price of gold currently. Conversely, real yields above 2% have pressured gold prices. So when the yields get above 2%, we see that gold prices have been pressured. So what we want to keep in mind right now is that yields are currently still low, below 1%, which is something that's supportive of gold prices. So if you're trading a long-term strategy and you're looking at this, you might want to favor buy signals over sell signals. So that's how you might use this in the context of a trading strategy, a long-term trading strategy. Now let's talk about gold and the US dollar. Gold is commonly understood to have a negative correlation with the US dollar. So we're an inverse relationship. Gold, like other commodities like crude oil, are priced in US dollars, and this suggests that the two assets are inversely correlated. But while the correlation is negative the majority of the time, there are periods and have been periods when both gold and the US dollar rise together. And there's a number of factors that cause this. One reason is that both gold and the US dollar are viewed as safe haven assets. So money tends to flow into gold and the US dollar in times of geopolitical uncertainty. Japanese yen is also viewed as a safe haven. Gold is viewed as a safe haven more so than the US dollar, and the Japanese yen is viewed as a safe haven more so than the US dollar. So now let's talk about a technical gold trading strategy using the daily time frame. We're looking at the daily chart. So what I was looking for in terms of this strategy was a strategy that works well in a trending market. Moving average strategies tend to perform well in markets that are trending nicely. We want to look at not only the market that's trending nicely, but the time frame that's trending nicely, because certain time frames you'll see the market trending better than on other time frames. So looking at the gold chart, I saw that on the daily time frame the market is trending nicely, so that's why I chose this time frame for this strategy. So it's a moving average crossover system, so we look as an entry trigger for the 5-period exponential moving average to cross above the 10-period EMA for a buy signal. We look for the 5-period EMA crossing below the 10-period for a sell signal. So that's our basic entry trigger. And then we have a few filters that we want to keep in mind. So we want to favor buy signals when the price is above the 200-period SMA. So we're going to pull this up on the chart, and you'll be able to have a more visual understanding of this. But we're going to favor buy signals when price is above the 200-period SMA. We're going to favor sell signals when price is below the 200-period SMA, the simple moving average. We're going to favor buy signals when the RSI oscillator is curving up and crossing 20. And we're going to favor sell signals when RSI is curving down and crossing 80 from above to below. And we're going to also consider basic fundamental questions, some of the stuff that we covered earlier on. So something else to think about is where are real interest rates? We know that real interest rates are below 1%, so with the understanding of this, we may give a slight favor to buy signals over sell signals. We want to ask ourselves, is there safe haven demand in the market? Not so much right now, but if there was, if some, for example, if some news came out of North Korea that upset the markets, we might want to favor buy signals over sell signals in gold, knowing that gold enjoys safe haven demand. Another thing that we want to consider is what's going on with the US dollar. How strong or weak is the US dollar? And another factor related to this is how strong or weak is the US economy, and what kind of data is coming out of the US economy. So for example, if a string of negative data came out reflecting a weakness in the US economy, and we saw a weak US dollar, we might favor more buy signals in gold. So here, those are some examples of how you can use fundamental conditions as additional filters in your technical trading strategy. So with that, let's jump over to the charts and take a look at this strategy in action. Okay, so now here we have in MetaTrader 4, we've got gold against the US dollar. We're looking at the daily time frame, and here we can see the 5 and 10 period EMAs, the 5 and 10 period exponential moving averages, which are giving us our entry trigger for buy and sell signals. So we can see on this daily chart that the market is trending nicely. Look at this nice uptrend here, nice fluid up move. We have a fairly nice fluid down move. Keep in mind that we're looking at the daily chart, so this is a fairly long period. This is looking from July all the way into August when it peaks here, and then we're looking from, or September even, and then from September down into October. So these are fairly long moves. So we have a nice fluid up move here, a nice fluid down move here. So we're looking at a fairly nice trending market. Now this isn't necessarily the case on all time frames. Let's take a look at the hourly chart and see how nicely it's trending there. Okay, hourly is trending fairly nicely. Let's look at the H4. Also trending fairly nicely to the upside. But in some time frames, we have periods where the market is moving sideways. So for example, we're looking at the half-hour chart here, and using a moving average strategy, you may have got chopped up here, although there was a nice down move that came later on here. So trading fairly nicely across multiple time frames, but I think particularly on the daily time frame, it's trending nicely. So let's go back and look at our entry triggers and the additional filters. So for example, here we had a buy entry here on the daily chart. There was a nice corresponding up move, and you wouldn't have got taken out of this move until there was a reverse crossover to the downside with the 5 period crossing below the 10 period to the downside here, and here you got your sell signal. The RSI crossing from above 70 to below 70 here was an additional factor suggesting that that was a good place to sell. So you had a confluence of indicators here. You had the RSI crossing from above to below 70 and the crossover here. So you had a pretty strong sell signal here, followed by a fairly fluid move to the downside. You have the 200 period simple moving average here, which clearly provided support and was taken into account by the market, it appears. And this is a useful additional filter where you're going to want to favor buy trades that are above the 200 period simple moving average, suggesting that you're in bullish territory, and favoring sell signals below the 200 period simple moving average, which suggests that on this time frame you're more in bearish territory. So, and then again, to touch on the fundamental factors that we covered, interest rates below 1%, so you may be favoring on the daily time frame to some extent buy signals over sell signals. You're going to want to be looking at strength or weakness in the US dollar, what's going on with the fundamental data that's coming out of the US economy. And finally, you want to be aware of what's going on geopolitically and ask yourself, is there safe haven demand? And if so, then you're possibly going to want to be favoring long trades over short trades in gold. So with that, guys, I want to thank everyone for joining us today. I hope you join us for the next educational presentation, and wishing you good trading for this week. Thanks again for joining us.